Hey there, this is KG coming to you live today from Bowie. So we're talking about tax advantages of homeownership as well as what are the advantage tax-wise if you're a real estate investor, even if you just own one property. So today I'm talking to one of my go-to guys, Zopia Olumese. So this is KG. I'm a realtor with Fairfax Realty in Greenbelt, where we help buyers buy their dream home and sellers to sell their houses, and also help investors to invest in generational wealth. So listen, guys, if you're looking to buy, sell, or move, contact me below. And also don't forget to subscribe to the channel so that you can get updates once we upload a new video. So like I said, I'm talking to Zopia Olumese, who's a CPA managing partner with Otagwe and Olumese CPA. Take it away, Zopia.
Hey, KG. Thank you for having me. Definitely appreciate the honor of going on this interview. Again, my name is Zopia Lumise, and I'm a managing partner of O&O CPAs, or Otagbe and Lumise CPAs. We help clients manage their books for businesses as well as do tax planning and preparation services as well. So thanks for having me again.
No problem. So today we want to talk about what are the tax advantage of being a homeowner. I mean, are there any advantage to being a homeowner tax-wise?
Yeah, absolutely. There's a whole lot of advantages when you own a home. In fact, owning a home is like the first step to unlocking a whole world of different tax advantages. Those advantages start off when you pay your closing costs for your home, for that down payment, right? And they continue as you continue to make those monthly mortgage payments. Those monthly mortgage payments are included in there are your interest payments as well as tax payments for the property that you own. And that's where you're going to start seeing those tax benefits, right? So if you own a home, the mortgage interest payments that you pay will be able to be a qualifying deduction against your income. The same thing can be said about your property taxes that you pay, as well as all the interest that you pay. And during closing period, if you paid any points for interest deductions, then those also can be a deduction for you as well. And so that only can be available to you if you had a mortgage on the home.
Okay. So you said deduction. What does that mean when you compare it to credit?
All right, so that's an important distinction to know, credit versus deduction. What it is that a deduction is a reduction of your total income before taxes are calculated. A credit is a reduction of your tax liability after it had already been calculated. For example, let me give a quick example. So let's say you earned $100, right?
Mm-hmm.
A tax deduction would say, I earned $100 and I can deduct, let's say $20.
Mm-hmm.
Now, 100 minus 20 will be that $80. That $80 will be the amount that the taxes that the tax bracket percentage will be applied against to basically calculate your actual tax liability. That deductions happen before the calculation of that tax. So the $20 is going to be considered a deduction. Now let's say, okay, you had 100 minus the 20, you're going to have $80 that are subjected to tax. Let's say you're going to pay 10% tax. And so 80 times 10% is $8 in tax. That $8 that you owe, let's say you qualify for a credit. A credit is going to reduce to $8. So let's say a $5 credit. Now that $8 reduced by 5, and now you owe $3. So that's the big difference between a credit and a deduction. Yeah.
Oh, okay. So a deduction is better. So it reduces your tax liability up front. So what are some of the things? I know you ran through them, but give me specific things that we can deduct in the taxes if you're a homeowner.
You said some of the things that you can deduct. We spoke about mortgage interest deductions, right?
Okay.
Property tax deductions. We talk about points deductions. There's another one that you also can deduct that many people, first-time home buyers, might be jostling with, is private mortgage insurance as a deduction, right? Usually, if you haven't put down about 20% on the home and you don't have that equity, you're going to be required to maintain some type of mortgage insurance. The acronym is PMI. That's what we're mostly familiar with. But to your benefit or to the benefit of the homeowner, that can be deductible also in your taxes.
Oh, okay, okay. So, but this disadvantage is can somebody that is renting a house, can they take advantage of this as well?
So when you're renting a house, you actually lose out on that possibility. You don't get to. It's only the person who actually owns the house. The only way that you can take advantage of rental of of deductions if you're renting is if you are a business owner, and it's very specific situations, right? So if you're a business owner and you also own a home or you rent a home, there's an
Mm-hmm.
opportunity for you to take additional costs against your income as deductions if you have a home office,
Office. Okay.
right? So for the renter, if they have a space that they define as their home office,
Mm-hmm.
and it's a qualifying home office, meaning it's legitimately a home office,
Mm-hmm.
a lot of your rent expense can be prorated as a business deduction or deduction. The same thing can come, so the same advantage can be taken for homeowners
Okay.
who designate a place in their house um, as a business, as an office, and they can then take a prorated amount of their mortgage, of their utilities, of costs related to maintaining that space. So
Okay.
that only is available. The is available to both renters and homeowners, but is more advantageous for the homeowner.
Okay. So now you just talked about taking deduction for your interest rate, for your taxes, the yearly
Mm-hmm.
taxes for the PMI, but you now just said even for a homeowner that has an home office, you can take part of the mortgage you pay for that specific space as well as
Mm-hmm.
the utility in your
Mm-hmm.
tax. Oh, okay.
Mm-hmm.
Okay, that's good. That's good.
Mm-hmm.
That's for the homeowner. So what are the things that the homeowners need to get ready before the tax time arrives so that they can take advantage of these things? What are some of the things that they need to do?
Well, you need to make sure you keep track of your mail. You don't want to just be throwing away things from your mail, because your lender or your bank is going to send you over very important tax documents.
Mm-hmm.
The 1098,
Mm-hmm.
yeah, your 1098, which is a summary of all of your mortgage activity.
Mm-hmm.
That's really going to be your bread and butter in terms of taking your tax advantages, tax deductions. If you have a home office, what you need to be doing is documenting all of the expenses related to specifically that home office.
Mm-hmm.
If you don't if you don't keep track of them and have the adequate support, such as receipts or other things to track those expenses, like your credit card statements or so,
Mm-hmm.
you're going to be putting yourself in a bad position in terms of being able to qualify for those actual deductions.
Oh,
So you need to keep track of that. Another thing you want to know is to keep track of, or to know what your square footage of your house is in
okay.
total, as well as the square footage of your actual home office,
Okay.
because all of the expenses related to your home office that are common to the entire house need to be prorated based on home office square footage over total house square footage.
Oh, okay. 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 So that's for home ownership. It's good, right, to be a
Yeah.
homeowner. That's the advantage. Now,
Mm.
let's take it one step further. What about somebody that's already a homeowner now is buying an investment property to rent out? Are there tax advantage to doing that?
Yeah, absolutely. So many of the tax advantages that we see is they are unlocked when you start becoming a business owner. And
Mhm.
so when you are an investor
Mhm.
in a full investment property, the mind switches from a tax perspective. You're no longer just a personal primary, like doing things with your money, but you become a business owner. And that's really when the tax code starts working in your favor,
Oh,
right?
okay.
And so when you're a real estate investor, literally about everything, the general rule for business owners, including real estate investors, is that all of the costs related to you, all the costs related to you operating that business can be business deductions in a
Okay.
sense,
Okay.
right? So you're going to be able to deduct not only what you can deduct as a homeowner, but a whole lot of things, a whole lot more. So that includes interest, that includes your property taxes, that includes any repairs that you do on the property. That includes all operating expenses. If you furnish the home for your renters, if you stock toilet paper and tissue paper in the house, if you provide Wi-Fi, if you provide anything, literally, those things are going to be counted as appropriate or qualifying business deduction. But one of the biggest deductions that really separate, home ownership, the advantage of home ownership and real estate investment is the depreciation deduction.
Okay.
As a homeowner, you're not able to deduct the depreciation, but as a business owner, aka investor, that your depreciation is available to you. And what that and you, it's important to know what that is. A depreciation is simply a cashless deduction.
Mhm.
It's a deduction for is a deduction for the passage of time over an asset that you use.
Okay.
So I have an asset. So very basic concept. If I have an asset that's $100,000
Mm-hmm.
and I say, okay, this asset is gonna last me for I don't know, 10 years or so. I say, okay, every 10 years, the value of this is gonna drop by 10,000 or so. So you're gonna say the next year, when you're after that year passes, you're gonna be able to take that 10,000 depreciation deduction off on your tax return without ever paying out $10,000.
Oh, wow. And
Yeah,
that's not affecting the value of the property either. This is just
it's
paper.
not. No, it's not. It's really just paper. So we most of the time we only know about depreciation when we talk about cars that we buy,
Mm-hmm.
right? And we see depreciation as a
As a bad thing.
bad thing, disadvantage.
Mhm.
But if you're the investor, depreciation is awesome.
Oh, okay. So now you take that depreciation on your taxes as a deduction
Yep,
every year.
yep.
You
Every
pay
single
your-
year for the life of that asset.
Oh, wow. So, but then what when you sell it, you have to pay back that deduction.
There is so this is where it's important to consult your professionals because
Okay.
there is when you do sell a house that has been depreciated,
Mm-hmm.
there are some depreciation add backs that will be added back to reduce some of the gain that you had, or to calculate new tax on that gain, right? However, um, real estate investors have the unique opportunity to how do I say it? Take the proceeds from one investment that they have
Mm-hmm.
sold
Mm-hmm.
and flip it to another investment, completely avoiding the capital gains tax that
Okay.
are related to that. And that's what and we know that to be called a 1031 exchange. That
Mm-hmm.
allows you to avoid the taxes that you would pay based on the depreciation recapture and any gains that you acquire, and put it into another property, and the money doesn't really touch you, but your property value goes up,
Mm-hmm.
but you don't pay any taxes. And as a homeowner, that's not available to you.
So it's just for
For
being real
investors,
estate
yeah.
investor. Oh, okay, okay, okay. So part of the deduction for I'm now talking about for investor. Part of deduction you said taxes, upkeep. What about if you invest in a townhouse that have a homeowner association and the owner is
Yeah,
not paying it? Can you deduct that?
absolutely. Any cost that is related to and that is appropriate and necessary for you to continue running your business. Homeowners association costs are required for whatever property that you have, so it can
Mm-hmm.
be deducted. Lawn care from your local guy who you pay, I don't know, $30 every time to mow your lawn. That
Mm-hmm.
can be deducted. If
Mm-hmm.
you went out and bought some paint just so that you can physically paint the doors in your house,
Mm-hmm.
that can be deducted. You
Oh.
fix, yeah, literally about everything. And if you are and if it's a whole investment property and you're not living in there, you're gonna take 100% of those deductions.
100% of everything that if you're
Yeah.
not living there, 100%
Hmm.
of everything, all the expense that acquire
Yeah.
for that property, you can take all the 100% of it. Oh, okay. So that will greatly reduce your taxable income.
Correct. Yeah. And so what happens is now
Mhm.
if that property turns out to be in a loss position for your taxes,
Mhm.
in certain cases that real estate um, those real estate losses might be able to cover some of your ordinary income. But specific cases that there's going to be some extensive research that your tax professional is going to have to do.
Mhm.
But yeah, essentially those it would reduce your taxable income for sure.
All right. Okay. Wow. So advantage to buying a house and advantage to be a homeowner. Okay.
Mm-hmm.
Right. Right.
Yeah.
So thank you, Zopia. Thank you for chatting with me. Guys, like we said, it's always good to talk to professionals, and that's why I'm talking to Zopia today, who's a CPA. Zopia Olumese, can
Yeah.
you flash your contact information for me?
Yeah. Let me find that for you. So you can find me. So my name is Opio. Let me say you can find us at our website at oandocpas.com. That's oandocpas.com. You also can find us on Instagram, Twitter, and Facebook, and LinkedIn, all from the same name. The full name is Otagbe and Alumise CPAs. I'm sure KG will post it on her description. Sometimes our clients find that to be a mouthful, but O and O CPA you should be fine with that.
Okay, no problem. And I have his information as well. So if you're looking for a CPA, definitely contact Zopia Lumese. If you're looking to buy, sell, or invest in real estate, contact me and subscribe to the channel. Zopia, we'll talk again. Ciao.
Thank you. Bye.